Hey everyone, in today's video, I'm going to show you why I stopped buying stock a long time ago and replaced it with this incredible options trading strategy called buying deep in the money call options. So if you're interested in number one, learning how to reduce your risk, saving you a ton of money, and number three, more than tripling your return on investment, then you're going to want to stick around and watch this video. So let's go. Hey everyone, I'm Lee Lowell, founder of smartoptionseller.com, an options trading website dedicated to helping you become a better options trader. So in today's video, let me move myself over here, we're going to be talking about the Smart Option Seller Guide to buying deep in the money call options. Now the point of this video is to show you how using this options trading strategy is so much better than buying the stock itself. And my goal here is at the end of this video is that I can convert you to becoming an options trader instead of buying the stock. Now, we're going to run through the reasons why buying deep in the money call options is better than buying stock. And we're going to use an example today using Walmart stock. Okay, just an example. It can be used on any stock that you want. So that's the great thing about this options trading strategy, buying deep in the money call options. So let's just run through how it works. We're going to show you an example, and then by the end of the video, my goal and hope is that you will see the benefits of this strategy. So let's talk about the three main things. So now, first off, we just have to make sure everyone understands that option contracts contain 100 shares of stock. So every single option contract is valued at 100 shares of stock. So in this example, when we're talking about this strategy, we always have to compare buying 100 shares of stock versus buying one deep in the money call option. Okay, so if your goal is to buy, a handful of shares, like maybe 5 shares or 10 shares, this strategy won't work for you because we have to compare 100 shares of stock to the strategy. But even then, it's still going to work for you. So let's talk about why this strategy is so great, and then we'll go through the example. Number one, as I said, buying the call options is going to save you a ton of upfront cash versus buying 100 shares of stock. Number two, it's going to give you so much less downside risk than buying 100 shares of stock. And number three, this one right here, this is the biggie, over 350% better return on investment. Okay, so how do we do that? How does that work? We're going to buy, instead of buying 100 shares of stock, I'm going to show you how to buy a deep in the money call option instead. All right, so it works like this. You're going to buy a deep in the money call, and I'm going to bring up an option chain of Walmart, and we'll show you exactly which strike you should buy. But the key here is something called the delta. The key to buying the proper deep in the money call strike is by finding that strike that has at least a 90 delta. Okay. For those of you that may not know, delta is just one of the Greek outputs of the option pricing model, and it describes the movement, the potential movement that the option price will move in conjunction with the stock price. So every option has its own price, and that price fluctuates based upon how the stock moves. So a 90 delta, the delta itself tells you how much the option price will move in accordance to how the stock moves. So why we want to concentrate on a 90 delta is because we want the option price to move 90% of whatever the stock moves. So if the stock goes up $1, your call option will go up 90 cents. So it's going to track it 90% of the time. That's what delta is all about. I'm going to show you how to find that. Now, we also want to use a longer expiration date, and this is my opinion, because if you're bullish on a stock and you want to hold that stock for a long time and gain all the upside potential appreciation, you want to choose a longer option expiration date. And all options have different expiration dates. You have 0-day expiration, 1-day expiration, 1-week expiration, 1-month expiration, 6 months, 1 year, 2 year. Options have many different expiration dates. But when we talk about using a longer expiration date, I'm talking about at least a year, 9 months to a year out. And you can use it on a 1-day option, a 1-day expiration, but you really have to be sure that you know the stock's going to go up. Now, buying deep in the money call options is an extremely bullish strategy. All right. So if you're going to use this strategy, you have to be bullish, bullish, bullish on the stock that you're choosing. Just as you would buy a stock, you're bullish on that stock. If you're going to buy deep in the money call options, you have to be bullish on the stock for it to work. So most of us don't always get the stock direction right off the bat, unless you have some kind of inside information. So you want to give yourself more time to be correct. That's why my thing is that I like to choose longer expiration dates, because sometimes the stock will move against you for a while before it eventually starts to move in your favor, okay? And the third thing is here, we want to try to get an option break-even price that's pretty close or somewhat close, within a few $100s of as if you were buying the stock. So if you bought a stock at 100, your cost basis is 100. Now, if you buy an option contract instead of buying the stock, you want to have that options break-even price, somewhat close to the current price of the stock. That way, it'll tell you how far the stock has to travel before you start making money on the option. And we're going to show you how that works. So let's jump right into our example and show you why buying the deep in the money call is superior to buying the stock itself. We're going to use Walmart as our example. This is not an actual live recommendation. This is just an example only, okay? So as of Friday, where are we? March 31st, 2023, Walmart stock closed at $147.40, okay? If you were to buy 100 shares of Walmart stock, it would cost you $14,740. And in this example, what we're going to do is we're going to buy the Walmart January 2024, so roughly, 9 months in the future, the deep in the money call option, DITM stands for deep in the money, $115 strike call for $37.30 per contract. Okay, for those of you that know or may not know, option contracts, like I said, are based on 100 shares of stock per each option contract. And that's what the 100 multiplier. So whenever you see an option price in an option chain, you have to multiply it by 100. Okay, so the option contract costs $37.30, multiply it by 100, it's going to cost you $3,730. Now you compare that, $3,730 versus the buying 100 shares of Walmart for over $14,000. You're going to save $11,000 right there off the bat. So number one, you're going to outlay $11,000 less to get your hands to control 100 shares of Walmart. It's 74.4% discount to buying the actual shares of stock. Okay, and the break even, in this case, if you bought the option instead, you need Walmart to get up to $152.30 versus the break even of if you just bought the stock. Your cost basis and break even is $147.40. If you buy the option, Walmart has to climb about $5 in order for that option to break even. Now, why did we pick this option? Let's go over to our option chain and let me show you Walmart option contracts here. So this is an option chain from Walmart using interactive brokers. Call options on the left, put options on the right, and we have Walmart. And we're looking at the January 2024 expiration date. So here's how you do it. So the number one thing is when you're going to choose a call option instead of buying the stock, what I said is you have to find a delta that's at least 90 or greater. So when you're looking at your option chain, you want to make sure you have the delta column right here, delta. Okay, and deltas range from 0 to 100. And that means 0% to 100%. Deltas are in percentages. So you want a delta with at least 90% or higher, but I think 90 is fair enough, okay? So you're in the delta column, here's your strike column. So you want to find the call option strike that has at least or the closest to a 90 delta. So it's the 115 strike, 115 call option is very close to the 90 delta. And you scroll over to the bid-ask column, that'll tell you how much the option costs. So we split the middle in between the bid-ask here. So we come up with $37.30 per contract. That's how we chose this specific Walmart option contract. So we got the 115 calls, you check the delta column here, and then you see how much the price is. So if we go back to our cheat sheet here on how to buy the call options, so there it is. You buy the Walmart 115 call at $37.30. It costs you $3,730. Okay. Now, what I want to show you is some of you may be saying, well, how do I know buying this option is going to work? As you say, why is it so much better? Well, I made up a little spreadsheet here, a little matrix at various stock prices, why buying the call option is superior to buying the stock instead. So I've got a bunch of different random stock prices here, higher or lower, and we've got the stock P&L, the stock return on investment, and the 115 call profit loss column, and the return on investment. So I want to show you what the numbers look like at various stages of Walmart stock moving up and down. Okay. So let's go to the worst case scenario for both the stock and option. Okay, let's just say Walmart drops to $0 per share. Okay, if you are the stock buyer, you're going to lose your whole investment of $14,740. That's 100% of your investment. If you scroll over to the other side here, if you bought the call, the most you can ever lose is whatever you paid for the option. And in this case, that's $3,730. Also 100% loss of your total investment. If we move up to $50, you're losing $9,740 on the stock. This should be a negative minus 66% there. And I could put a negative sign in there. Make sure you see that, okay? But also, the option, you're only losing $3,730. Also 100% loss on your investment, but the dollar amount is always going to be smaller than the stock loss. Even at $100, the stock buyer is losing $4,740, whereas the call option buyer is still only losing $3,730. Even though it's still 100% loss of the option investment, dollar-wise, it's still less than what the Walmart stock buyers are going to lose. Okay, so on your ultimate downside, you're losing less money, although the percentage is high, you're still losing less dollars, which is more important to me. Okay, so now here we're at the break-even prices for both the stock and the option. Walmart at $147.40, you're breaking even. The call option, you're losing a little bit of money, a couple $100 and 13%. Okay, here's the option break-even price, $152.30, nothing here, and the stock price is making a little bit of money and a little percent. But here's where it gets really good. If Walmart stock or whatever stock you decided to use in this situation, if the stock starts to go up in your favor, here's where it gets really good. So the next price we're looking at is $200. If Walmart went up from $147 up to $200, let's look at the results. The stock buyers are going to make $5,260, which is a 35.7% return. The call option buyers are going to make $4,770. Now, yes, it's a little less, a couple $100 less than the stock buyers, but here's your return on investment, 128% return on your investment. More than triple, more than 3 times the ROI of the stock buyers. Why is that? Because when you bought the option for only $3,730, your upfront cost is so much less than the $14,000 you're going to spend for Walmart. So when the stock goes up, you're going to get much better bang for your buck, 128% return. At $250, here's how much the stock buyers make, $10,260. The option buyers make $9,770. Yes, still a couple $100 less, but a 262% ROI versus a 69.6% return ROI for the stock buyers. Once again, over 3 times better return on investment because you have less money at risk. You've put less money down. And at a $300 price tag for Walmart, you can see the numbers. Dollar-wise, they're almost the same, but once again, the ROI is more than triple, almost 4 times as much, okay? So no matter which stock you choose, no matter no matter where the stock goes up or down, you're always going to lose less dollar-wise on the way down. And on the way up, you're going to make almost the same amount dollar-wise, but your return on investment is just going to be skyrocketing. So that's the reason why I would rather buy a deep in the money call option versus buying 100 shares of stock. Now remember, it's based on 100 shares of stocks. Now, if you only want to buy 1 shares or 5 shares of Walmart, it's not going to work out so well because the option contracts are based on 100 shares of stock. Okay, so if we go back to our cheat sheet here, so what happens at expiration come next January 24? What do you do? Can you get out of the trade? Can you sell it? What happens? So there's 3 things you can do at expiration. Number 1, if the option is profitable, you can just sell it, or you can sell it regardless. And at that point, it's going to be based on where the Walmart stock is. So you can always sell the option anytime you want. You don't have to wait until expiration. You can always sell the option, and you'll sell it for whatever the price is of the option at that time. And that might be a profit or loss for you at that time. So you can always sell the option, get out of the trade, you're done. The other thing is that if the option is in the money, meaning if Walmart is above your break-even price or above the strike price, I should say. So if Walmart's above $115, although you'll still you can decide whether you want to exercise the option. If the option is in the money, meaning Walmart's above your strike price, you can exercise the option and turn it into actual shares of stock. Now, if you do that, the thing that you have to remember is that you have to pay for the balance of the stock at that point, which is $11,500. So your strike price is $115. You multiply that by 100. Here's your balance payment. So it's like a balloon payment at the end. Right. So the great thing about buying deep in the money call options is that you don't have to pay this balloon payment until the very end if you want to exercise the option. Okay, so you're only putting, it's like, it's a down payment at the beginning of the trade. That $3,000 is the down payment. So if you want to exercise it and turn it into actual shares of stock, you'll have to come up with the balloon payment. But there's another thing that you can do where you won't have to do the balloon payment, and that is you can roll the trade. What does that mean? Well, if you're coming to next January 2024 expiration, you can sell your current call option on Walmart and now buy yourself a new deep in the money call option for 2025 and just pay the small amount upfront cost just like you did in this first one. And then in 2025, when it comes due for expiration, you can roll it again if you want to, if you're still bullish on Walmart. So you'll never have to make the balloon payment. You can just keep rolling the option. Now, like I said, if you want to get out at any time, you can just sell it, which would result in a profit or loss, depending on where Walmart stock is traded. So let's talk about risk here real quick, and we'll call it a day. Risks to the strategy. Number 1 is that what if Walmart keeps dropping? Okay, below your strike price, 115, down to 100, down to 50. That's the risk you have with any bullish position, whether it's stock or call options. The stock could keep dropping. That's the risk that you take for any bullish investment. So you just have to know you can lose money. You can lose money with this strategy. You can lose money by buying stock. So just remember, if the stock goes down, you can lose money. Now, what can you do to mitigate that? Well, just like if you had a stock position, do you have a stop loss plan, which is, do you get out of the trade if the stock reaches a predetermined level or falls to a predetermined level? So if you bought Walmart at 147, do you have a stop loss, or are you just going to hold it until it goes to 0? You have to decide that. Most people put in maybe a 20%, 25% stop loss. So if Walmart drops 25% in price, they're out of the trade. They sell their stock or they sell their call options. You have to decide what the best risk mitigation plan is for you. Okay, I can't tell you what that is. Everyone has their own thing. All right, so that's really it. That is the reasons why buying deep in the money call options, in my opinion, is much, much better than buying stock itself. Okay, you want to use the market to your advantage. And to me, that's all about saving money, less risk, and better return on investment. Those 3 things right there. All right. So that's it for that. I hope everyone has got some value out of this. For those of you also, at the smartoptionseller.com, we are mainly option sellers. This is the one and only option buying strategy that I'd like to talk about. But for the rest of the time, we're option sellers. So if you are interested in learning how to sell put options, you can go to our website, get our free Put Selling Basics ebook. This is all about how to sell put options. Scroll down here. This is on our website, smartoptionseller.com. Scroll down, put your name and email address here. We will send you an email with a link to download the copy of the free Put Selling Basics ebook. Okay. Now, I'm going to put on the screen here an older video that I did of buying deep in the money call options, just to get another perspective of how that works. So if you're interested in learning even more, watch the next video. Okay, I hope this has been helpful. Give me a thumbs up, leave me a comment, send me an email. I always answer your emails. I'm here to help you. I want to make you a better options trader. All right, so that's all for me today. I hope everyone has a great weekend and a great trading week ahead. This is Lee Lowell signing off. See you next time.